Now onto the MidCap Masala show. It's time to connect with our first management onto the show. And today we're going to be speaking with the management of Royal Orchid. And let me welcome Mr. Keshav Balji, who's the Executive Director of Royal Orchid Group, joining us on the show. Hi, very good morning. And firstly, let's start by talking about your deal with Hilton. This deal targets to open 125 Hampton by Hilton hotels. What is the expected timeline for the rollout, and how will these signings and openings will be paced over the next few financial years? Give us some sense.
Yeah, thank you for having me. We are excited to announce that we will be opening 125 Hampton by Hilton hotels. As you know, Hampton by Hilton is the leading mid-scale, hotel brand, ranked number one by Entrepreneur Magazine for over 17 years, and is the largest brand in the Hilton portfolio in terms of number of hotels. We will be rolling this out across six states in India over the next 10 years. So this is the long-term strategic tie-up. We will be the master franchisees. That is the subsidiary of Royal Orchid Hotels Limited. Regenta Hotels Private Limited will be the subsidiary, the master franchisee. And we will be rolling out these hotels in management contracts with hotel partners and hotel owners across six states in India.
Balji, that sounds good. I'm just trying to understand a little bit more. Will the business model for these hotels be franchise? Will it be management contracts? Is it going to be a mix of both? And what kind of fee income or margins can Royal Orchid expect over the course of the next 10 years?
So our subsidiary, Regenta Hotels Private Limited, basically is a management company, and we basically are an asset-light business. We manage hotels which are built by third parties. So we have a real estate developer who builds a hotel, and our company then manages it. So we get a fee income, and our EBITDA margins are close to 50% in this business. Currently, our fee income is on an approximate run rate around 45 to 50 crores per annum. We expect this to accelerate quite well due to this particular deal, as well as the growth in our Regenta brands as well. Um, so if there's anything I could clarify in terms of the management contract business, very quickly, basically these are long-term tie-ups. We do not invest in the hotel. The hotel typically costs around 50 to 60 crores to build. That is put up by the landowner or the real estate developer that we tie up with. We take these hotels on long-term contracts. We manage the sales, marketing, talent management, regional sales offices, revenue management, and things like that. And so essentially, we manage the hotel on an end-to-end basis, deliver value and growth in terms of both yield on an annual basis to the real estate developer, as well as growth in the asset value over time. So this is a very good model for folks who are diversifying their family offices or their real estate holdings. You get professional management, you get a global brand, and you're able to earn a good return on income as well.
Understood. So that gives us a lot of sense on the operating model. So just the key takeaway from what you've just said is that this is not going to impact your capex requirements, this 125 hotels. No impact on capex, and via this, you will still continue to remain with your asset-light strategy, right?
That's correct. That's correct. We basically will be looking at an asset-light growth henceforth. We are opportunistic. We do have a reasonable amount of cash on our books. So we are opportunistic. If there are some assets that come up for sale or on a lease or revenue share model, we will consider that as well. We have been doing some revenue sharing deals as well, which is slightly more capex heavy than the management contract model as well. And you will see that in our top line growth as well for the Royal Orchid Hotels Group, which is likely to accelerate.
All right, point taken. But along with that, Hampton is positioned in the upper middle scale segment. How does this complement or complete with your existing Regenta portfolio?
So Regenta is a full service mid-scale brand which has banqueting, events, multiple F&B outlets, things like that. So it is what is called a full service hotel. Hampton is basically a focused service hotel, which means it primarily focuses on the rooms, and it has limited food and beverage outlets. We are finding that a lot of real estate developers, especially in mixed-use developments, have a lot of restaurants already in the space, and so there is a demand for a room-centric hotel product. And I think this is something that is going to grow quite aggressively going forward. And of course, I think it also works out very well for the developer because you're not building all these extra ancillary services, which typically don't yield as much on a per square foot basis. So we find it's very complementary to our existing portfolio. It allows us to sweat our existing assets a lot more because we've already built out regional management teams, regional sales offices, centralized revenue management teams, centralized HR accounts, all of that stuff. So that stuff gets sweated over a lot more hotels as well because we now have one more brand to offer to our real estate developer partners. And of course, I think we're also very excited that this is the biggest brand in the mid-scale space globally. So it is really, for us, a gold standard brand. We're very happy to be associated with Hilton for this.
Really good. Mr. Balji also talked to us about the trends that you're seeing on the demand and supply front. Now, given your current occupancy and rising ARR, both of them have been rising consistently. Do you see demand strong enough to absorb such an aggressive supply addition? I understand it's over the course of 10 years, but still, if you could give
Right.
us a sense of this demand and supply situation.
Yeah. Yeah. So look, since the pandemic, obviously the market has been on an upswing. We actually have been actually quite aggressive ourselves. We have almost, because we are currently at 125 operating hotels, we have over 50 projects which are coming up now, which means these are signed hotels and they're under construction or being converted as we speak. We have a very aggressive target of 345 plus hotels in our Vision 2030 plan. So we believe that, look, India is definitely under-penetrated with hotels. We believe that in the next 5 to 10 years, there is going to be aggressive amount of hotels being built by real estate developers across the country. These developers need professional management. Today, it's very difficult to attract, train, and groom and promote staff if you don't have a large chain in which you can, provide the career path to employees. And I think that's one of the critical aspects that people are overlooking. And only good talent would like to join, large platforms such as ours. And so we feel we have a unique advantage. And as these hotels get built out, they would require professional management. And therefore, we are positioning ourselves very well for this upswing that's about to come up. But I think that you're right that, look, the hotel business is something that tends to be over the long term cyclical. In the short term, I mean cyclical. But in the long term, there's a huge structural change in the Indian market. As our per capita income will double over the next 10 years, you will find that a lot more discretionary travel will happen. And more importantly, there will be a lot more travel as India builds itself. So every time you hear an announcement of a new cement plant being constructed, a new road being constructed, you know that there is some travel that is required for that to happen. So as India builds itself, hopefully the travelers and the builders of India will stay in a Regenta hotel or a Hampton by Hilton hotel, which is run by us.
All right, good to know about it. But along with that, help us understand a bit more on the financials and numbers. And what kind of ROS or payback period do you expect from these hotels, especially in the key markets like Goa and Maharashtra?
Yeah, so basically for us, obviously we only provide a very very limited working capital capex for these hotels. So we typically earn a fee income for helping these hotels be set up, signed, and then of course earn a monthly fee once the hotel is operational. So we are typically cash positive on these properties immediately. So it's a very high ROCE business for us. But for the hotel owners, because the Hampton product is focused service. So it is very, very high ROCE because what's happening is you are actually a very large percentage of the hotel is revenue earning. You don't have too many ancillary facilities which are not revenue earning. So we expect that the payback period for owners to be a lot quicker, almost 30 to 40% faster than a full service hotel. So payback periods for owners can range from 4 to 5 years to 6 to 7 years, depending on the market, and of course, depending on the land cost. Look, Goa, Maharashtra are some of the key markets in the country, including, of course, Karnataka, Tamil Nadu, Andhra Pradesh, and Telangana. All of these markets we have selected, handpicked, because we believe these are some of the most, positive and high yielding markets in the country. And also we believe that these are markets that are where a lot of the growth and development are happening in terms of projects, in terms of leisure facilities. So we believe that we can really penetrate these markets with the Hampton brand as quickly as possible.
And Mr. Balji also talked to us about everything that we're seeing geopolitically, given the ongoing West
Sure.
Asia conflict. And, we've heard the ceasefire to be at play to some extent. Now we're hearing the opposite. Are you seeing any changes in travel patterns domestically? Do you think the sentiment has been marred because of higher, let's say, airfares or travel costs? Do you think this has impacted the demand for travel and tourism, at least temporarily?
Look, of course, there's always going to be some dislocation, especially in the luxury space, when you have this kind of disruption in terms of flight paths, right? A lot of the airlines are having to take different flight paths, and therefore some are cancelled. So therefore, the airfares have soared. And at the same time, there is a bit of uncertainty as well in terms of the market, and of course, you see it in the stock prices every day, which are quite volatile. That being said, the reality on the ground is that we are very much a domestic consumption story. And we believe, and we are basically a trade on India premiumizing in the next 10 years, as we grow our, per capita income. So while there are some small disruptions in very, very minor markets, keep in mind that we run over 125 hotels in 80 plus cities. We aren't seeing cancellations in more than 3 to 4 of our cities. In most folks, for them, domestic travel is on. Business is as usual. That being said, if we have some calamities in terms of large scale LPG or oil. Or even international travel disruption for a very long period of time, then we, along with the rest of the economy, will definitely suffer. But at this point, we don't see that playing out on the ground. So that's very positive for us.
Okay, so that's actually working in your favor. It's not marred any of the demand or the occupancy, so that's good to know. Mr. Balji, lastly, before we let you go, just wanted to get a better sense on your Vision 2030. You're targeting 2x growth. You've already, if I'm not wrong, you already have the target is 345 hotels, like you just told us, from the current 168, 170 number that you have right now. So you're looking to double that. Just want to understand if these 125 hotels are going to get added to this count, and does that accelerate your 2030 plan much before the timeline?
No, at this point, we would be relooking at the 2030 plan. We would like to continue with this current plan of doubling our growth. But we will not, increase our Vision 2030 targets right now. We would like to quickly ramp up. So the Hampton part would be definitely part of our Vision 2030. But we will come back to the market as and when we believe that we can do something a bit more aggressive. We're always looking at that. Of course, internal targets are always higher than what we speak about. We would love to see how this works out over the next 6 to 12 months. But we believe that achieving this Vision 2030 target now looks a lot more achievable with this tie-up, looks a lot more realistic. And I think we can probably beat it as well. So we will, over the next 1 or 2 years, come to the market with what we'd like to do. And of course, there are going to be other announcements as well going forward in terms of new signing, new hotels. And we look forward to sharing that with the public as and when those things are known.
Point taken. But with this, Mr. Balji, we let you go. So good having you on the channel today. Thank you so much for taking the time out and helping us with your outlook and views.
Thank you so much for having me.
All right, so that was the management of Royal Orchid talking to us about their latest deal with Hilton, and along with that, what's the outlook going ahead. We discussed all of that, but with this time now to slip into a very short break. Don't go anywhere. We'll be right back on the other side.